The best investors of all time, there's a reason why they believe the return on invested capital is one of the most important metrics to understand and know before you buy a company. Here at Everything Money, we pride ourselves on teaching you how to fish. We refuse to give you stock picks. If you just want a channel who's going to tell you go buy the stock, we're not the one for you. Go find one of the other channels out there and enjoy losing 90% of your money. Instead, we're going to teach you how to invest, how to research a stock, what to look for, and how to determine a fair value of a stock so that you know if it's at a good price to buy. And more importantly, when the stock starts to fall, you understand that it's just the emotion of the market and it's probably an opportunity for you to buy more. So in this video, we're going to teach you a lot about the things you need to know about ROIC, which is return on invested capital, and why it's such an important aspect to look at when you're thinking about investing in a stock. We're going to go over the basics of the metric, what it looks like within a company, and finally perform a stock analysis in which ROIC is a point that we're going to sit there and focus on when analyzing the company. So first, what is return on invested capital? This describes how well the company allocates its capital to projects or investments that generate any sort of profit. There are two ways to finance a business. Equity, which means you put your own money in or you raise money from investors. Or a second thing, you borrow money. If you borrow money, that's debt. So equity and debt. The invested capital in the business is the combination of the equity and debt within a company. So let's say, for example, you want to start a company tomorrow and you're going to spend $1,000. You're going to put in $600 of your money and investor money who's going to own the company, and you're going to have $400 in debt. The total is $1,000 there, okay? The return on invested capital then in the future will be the profit that you make on that divided by that $1,000. That's the money that's invested in the business. So again, very simply, it's the profit after tax divided by the total money invested in the business. So Mo, there's a big shift these days in how we assess companies compared to 100 years ago. Mm-hmm. And this is part of the argument, which I buy into, about why markets should be a little more expensive. Yeah. So how did companies now differ in terms of ROIC versus 100 years ago?
Well, back in the day, you're dealing with freight lines and all of these different businesses that are not what we have today.
Very capital intensive.
Exactly. You need so much money to go at them, and we don't have that really today.
Yeah,
we do, but there are certain sectors.
Correct. 100 years ago, in order to build anything, you had to have a factory, you had to have a lot of land, you had to have all these big expensive machines to generate profit. So there was a lot of money invested into a business to generate profit.
Now, with a lot of businesses, all you need is this. You're good to go.
Look at this channel.
Yeah.
This channel, guys, was started on $250,000. We bought cameras, we did a studio, we bought some computers, and we did that. Now, it's just profit. We didn't have to go build a factory. We spent $250,000, which is a lot of money, but we get a really good return on that. Same with software businesses now. Yeah. You see a lot higher returns on invested capital because you don't need as much capital to grow profit nowadays in a more service-oriented economy. Yep. Now, what's the difference between ROIC and ROI? So ROIC is return on invested capital. ROI is return on investment. ROIC takes the debt and the equity as calculating what's the return. The ROI just cares about the equity. Yep. Same as the ROE. It's kind of like, listen, what's our return on investment? What money are we making on the money we invest in this thing? So in that situation, the example I gave before of $1,000 split between $600 and $400, $600 in equity, $400 in debt. In ROI, we care about the $600 in equity. Just like in real estate. When I buy a piece of real estate, I don't calculate my return based on the total purchase price. I buy it based on what was my down payment on the company, on the piece of real estate. The reason I look at ROIC is, and I've learned a lot more about it. Mo, do you remember the first time you realized the importance of ROIC?
It was something, I was listening to a Buffett and Munger lecture on YouTube. And that's when I was like, oh, okay, this is interesting. And then it wasn't really until I heard Monish Pabrai say it. And he actually said it's one of his 3 things when he looks at for a multi-bagger. And that's when I was like, okay, this is probably important. I should probably look at this a lot more.
So it's funny.
Yours was real estate, wasn't it?
Mine was real estate. I heard about it. So decades ago when I was reading an annual report from Buffett, I remember him saying in the annual report, he talked about See's Candy. Mm-hmm. He goes, listen, See's Candy is a wonderful business because I don't have to invest a lot of capital into it to get higher revenue and more profit. He goes, it's very important to find businesses that are not capital intensive. Yeah. I didn't understand that until I got in the world of real estate, like you said. Yep. And then I started to realize, wait a second. I remember in 2007 or 8 buying a property, going to a bank, and there had a bunch of bankers there. I wanted to borrow money to go do a renovation. They all thought I was crazy. I remember thinking to myself, funny thing was, I value properties higher than somebody who's going to buy the property just as is. Because I look at what I can reinvest back in the property and really jump up those rates of return. And that's when I realized that ROIC was basically that, but for publicly traded companies.
Yeah.
And that's why you'll see me all the time when we talk about large companies, the problem I have with the ROIC metric, times that it's kind of, is it important or not, is can they really incrementally increase their profit? That, like Apple. Apple makes $100 billion in cash flow.
Right.
They have a 50-some% ROIC. They can't, if that's the case, if they could really invest at 50% today,
just keep reinvesting.
yes, but they can't because there's only so many things you can invest in.
Right,
Just like I had an apartment building. If I have 100 units, once I've renovated all 100 units, I can't go renovate 100 more units. It's just like, that's
return.
it.
Yeah.
Right. So I have to do something else with the money.
Right.
And that's one of the limitations of the importance of ROIC. But a lot of investors, a lot of value investors look at it as a moat. The higher the ROIC, the less they have to reinvest back in the company to get high rates of return, which means they have a control in that area. They're like, listen, we're sitting here nice. We're sitting here pretty.
Yeah.
Yes, we might not be able to reinvest at high rates of return, but people aren't going to be chipping away at us as easily.
Yeah,
and that's an important, exactly. Now, how does this pertain to stock analysis? Well, in our stock analyzer tool, which is our fundamental, how do we value this company, very top line talks about ROIC. When it comes to smaller companies that are still growing, you should use it as a way of saying, how can they drive their profit up at a high rate of return? But for a mature company like Apple, Microsoft, Google, all these big companies with high rates of return, like the high ROICs, it's kind of a fruitless kind of discussion, right?
It kind of screams moat, but that's about all it does.
So how do you use ROIC, Mo, when you affect these assumptions below? Where do you affect the assumptions below?
So if I see something like this, I know that they have a moat, right?
Yes.
So I'm going to on my desired annual return, I'm actually going to put something a little bit lower.
Right.
Because I'm going to say, you know what? There's not a lot of risk here. I'm willing to gain a little bit less return on this thing.
And remember.
And I don't need that high of a margin of safety.
Boom.
Yeah.
And remember also, guys, it's important. They can drive their revenue and profit, but I'm talking about large companies where it's hard for them to reinvest at higher rates. I use the ROIC to affect this area right here. I will sit there and say, listen, this is a moat. They deserve a higher PE. They deserve a higher prior free cash flow, and my money's probably more secure, so I'm okay with a lower desired return. For me, the high ROIC drives a higher PE, but a lower desired return. A low ROIC does the opposite.
Yes.
If I have a low ROIC, I sit there and say, listen, probably a lot of competition, probably a lot of risk there. I need a much lower PE and price of free cash flow. I want to pay less for every dollar of profit and cash flow. And I want a higher desired return because maybe there's not as moat. Maybe it's easy for them to fall apart. Maybe there's a lot of debt. I need a much higher return on that. So that's how I use in fact, ROIC has affected my investing decisions. Remember Walgreens, Mo?
Yeah.
Once I really fully grasped ROIC a lot better, I took Walgreens out of my portfolio. I sat there and said, nope, doesn't have a high enough ROIC.
Actually, 1.1%.
But
that's over the last 5 years.
And by the way, when I got rid of it, it was like 4% or 5%. So it's only declined since then.
Yeah.
So I sat there and said, listen, I'm not willing to hold this thing for a long time. Now, it might be a value play from the standpoint of a short-term play. But if you want to own companies, if you want to own good companies for a long period of time, ROIC is an important aspect. Now, I will show you one company I own and how it applies to me. Hewlett-Packard, HPQ. This is a company not sexy, not growing a lot, but look at this ROIC. 54% in the last year. It's like 300 some percent in the last 5 years or whatever it is. In 10 years, it's a little bit skewed because they had a lot of, even the 5-year number is skewed. But the 1-year number of 54%, I look at that saying, listen, they're doing a good job. They're going to buy back shares. They're going to pay down debt. They're going to make a better investment for, again, don't buy this just because I have it. And don't buy this just because Warren Buffett at one point owned it. But this is a way that I look at a company and say, okay, high return on invested capital. They're doing something good with the money. It shows that I'm going to sit here and say, all right, I'm willing to pay a little bit of a premium. But on top of that, you've got a very rare occurrence of a single-digit PE, price of free cash flow, a 5-year PE that's low. And I go, okay, maybe it's something there. Now, Hewlett-Packard has a lot of headwinds. That's why it's very difficult to find the Microsofts, the Googles, and all these things in the world with these great numbers and low multiple. In fact, when Apple did, the biggest concern about Apple was, can they maintain this hold on iPhone sales? They used to sell for like 10 times earnings.
Yeah. Something else about ROIC that's interesting is there's a lot of people that say you got to look at executives. You got to see how they're managing the company. ROIC can give you a really good magnifying glass into what that is without you having to go and understanding the executive team.
Yeah, 100% agree with you. ROIC is only one piece of the puzzle when evaluating individual stocks. We want to help you become the expert so that you can build long-term wealth picking individual stocks. So click this next video where we walk you through a real-life example of how to pick individual stocks. If you're ready to become a stock picker, I'll see you in the next video.